Our next guest warns Wall Street is still too bullish ahead of the CPI report. Danny Moses of the Big Short fame is founder of Moses Ventures. Danny, good to see you in person here at the NASDAQ market site.
Great to be here. Thanks for having me.
Are you net short in your portfolio? I mean, is that how you view the world?
I would say I'm not net long. I think there's opportunities. There's always opportunities on both sides of the equation. But the stuff I'm seeing right now, I think it's set up for short. So.
Okay. So what do you see happening tomorrow and what are your concerns?
I think the obsession with every print that goes by with all this economic data, whether it's 8.7, 8.4, PPI on Wednesday, whatever that might be, it's really about what's going on behind the scenes, and that's what's important. Earnings are coming down. Layoffs are starting to happen. Fed rates take a while to build themselves into the economy, and it's happening now. So we've seen peak earnings in this cycle for sure. We've seen probably the lowest rates in this cycle for sure. And what you guys were talking about earlier that really resonates with me is you would want to see 10-year yields now moving higher, not lower, because it's telling you something. So a 2-year, 10-year inverted by 50 basis points is telling you something. 2 negative quarter GDP growth is telling you something. And purchasing power is diminishing because the consumer is not keeping up on their wages with. So that's a bad witch's brew, as we say.
Witch's brew. He snuck in here, by the way. I'm sitting here looking at you. I turn around. He's right next to me. I will tell you, last summer, the only person talking about stagflation that I remember was Danny Moses. It's right before us now. So my question to you, Danny, with 2s, 10s going to 50 basis points inverted, there's no arrows in the quiver of the Federal Reserve to fight this. And they can say they're going to pivot, they're going to pause. But if they do that, commodities go back up and the inflation problem continues. How do they get out of this mess?
I mean, they're just, they're certainly going to pause at some point. But why would they pause? Is it because inflation's coming down or things just are stuck in the mud? I think it's probably a combination of both. I think we've seen peak inflation, but I don't know what they can do. They're unwinding an $8 to $9 trillion balance sheet here. So I tell people, this is a little bit of the 70s, 80s, 90s, 2000s. It's all kind of mixed in, but there is no precedent for what we are seeing right now. And look what has already happened with the Fed having done very little. I mean, already the builders have gotten hit. You see what's going on in that sector. So the consumer is starting to feel it. And with savings rates where they are right now, where they've dropped, there's not a lot of margin for error here on the consumer side.
So you spoke to employment a bit earlier. And so what we've seen so far is the unemployment or the peaking of unemployment that we're seeing is more so in the tech sector versus, the spending power is really being challenged in the lower third of the consumer base. What is it that the Fed needs to see from an employment standpoint in that middle third to upper third to get the people that are clamoring for this pivot to have something to kind of hang their hat on?
Yeah, I don't think they care so much about the middle and upper third. I think Walmart customer and Walmart told you the day before the Fed went. I think part of that pre-announcement was to announce to the Fed, look what's going on. We're going to tell you right now, the consumer is struggling. They're spending all their money on gas and food, and there's really nothing left. And so Fed is certainly watching that. That's going to have an impact. But there are layoffs occurring in the middle to upper now for the first time, and those are high-paying jobs, and that will have an impact, I think, on the market that we've yet to see. So this lag effect is now, I think, going to come around here.
So, Danny, you just said that investors are kind of whistling through the graveyard. What is that? Like similar the Big Short thing? What are they missing? Well, we just said the S&P just rallied 15%. That's one heck of a rally in a very short period of time, right? And so the NASDAQ, again, do you see today the market felt really sloppy? The NASDAQ was down 1.5%. But you know what? Microsoft and Apple were unched on the day, unchanged. It was keeping the S&P together here. So it really feels like, again, there's a lot of people calling for bottoms, that sort of thing. What are investors missing right here?
I think you can own the quality. I think you're going to see those stocks traded at a premium to the historical valuations because they're going to hide in them. These meme stocks, which I call obsessments, not investments, is really what they are. I don't even watch. I watch them to indicate the health of the retail investor, but there's not healthy what you see. Those are not healthy moves in Bed Bath & Beyond, AMC, GameStop. They're just not. And we know where they're going to end, or at least I think I know where they're going to end in. And so you want to own companies with strong fundamentals. You want to own companies with good, solid cash on their balance sheet, not lots of debt, because that's a whole other area that we can talk about maybe on a different episode, is what's going to happen when corporations need to come back for paper to fund their balance sheets. It's going to be a lot more expensive this time around. So those are all things that have yet to come, and I think that's coming on the horizon.
Is there a big short in your portfolio now? And I'm just saying, relative to other positions.
You're baiting me now.
Not necessarily.
There's one. There's one.
Well, listen, I'll just say, listen, Tesla, to me, is everything about this market that has been wrong. It's been bad enforcement by the government. capital markets, brokers writing research that, obviously for banking fees and so forth. And to me, when that thing finally breaks, if it ever does, and been wrong for a long time, but if and when it does, I think we'll know that the market has corrected itself because it has a little bit of everything in this market.
So this is a short position in your portfolio?
Tesla is a short position in my portfolio.
Since what level?
Well,
because a lot of people have gone broke shorting Tesla.
Absolutely.
Right?
I have not. So I made money initially years ago when after the Solar City acquisition. I thought for sure.
So this is a
people
long.
would realize.
I mean, this is a
it's been a war.
Multi-year, decade-long.
It's been a war. I've traded. I haven't traded as well as I probably should have, but now I think I'm geared up to a level where I'm very comfortable being short at these levels. So.
Okay.
All right.
Danny, good to see you.
Enough.
Thank you.
Good to see you.
Danny
Thank you, guys.
Moses. Julie Beal, what do you think, particularly about the consumer, the effects yet to come, the lag effect of the Fed's rate hikes?
Yeah, I completely agree. I think this is the time to be in quality. I think from a valuation standpoint, the rally that we've seen has really left quality behind. And so you can actually find good value there right now. For sure, I don't want anything that has a lot of leverage. I think that's very underappreciated by the market is how many of these companies have either variable rate maturities or maturities that are coming due relatively soon. And it's going to be a very different world for them coming back to the capital markets. And similarly, I think most of these tech businesses that are run by young CEOs, they've never been a manager in a recession. They're going to come across a very different world when they can't just get their way out of trouble by buying ping pong tables and beer taps. It's a new world for them.
Dan.
Yeah, well, I mean, I think the quality thing is a really good point. I mean, Danny just said that those names that are going to continue to be crowded in are going to trade at multiples. So if you want to get worried about, Apple at 27 times or whatever it is for like low single-digit revenue growth, I mean, again, we've all made that case again and again. But that stock did sell off 30% or so from its highs. The problem is it just rallied back. It's down single digits percent on the year, and I think you might see, you might see a lot of those smaller stuff that Julie just mentioned. That stuff is already down 60, 70. 80%. You know what I mean? So I don't just think that they're particularly interesting. I do think, though, that we're going to have an opportunity in the not so distant future where we see some of these big NASDAQ names that make up a huge percentage of the major large cap indices. They're going to show really good relative strength. And we're going to see all those names that have rallied 30, 40% off their lows, right, or that are down 60, 70% from their highs. They're going to retest those lows really soon. And that's going to be the moment of truth for, I think, for the stock market in general. And that's probably going to happen in the next few months.